This is Risk Reframed, the show where we bring you the leading risk experts from Moody's, our partners, and the wider ecosystem to discuss the risks organisations face, how they're interconnected, and ultimately what you, the risk professional, can do about them.
Jim, welcome, and Jill, welcome back. How are you both?
Doing well. Great to be here today.
Great.
Thank you.
Great.
Jill has actually had the pleasure of once being the co-host and interviewing me, but people will be glad to hear that we're actually going to hear someone with expertise in her and yourself, Jim, today. And we're going to talk about CDD specifically in banks, and I think with a particular focus given your guys' background and location, on particularly in America, where there are many, many types of banks, and CDD can mean different things. I want to start our conversation just, as normal, the normal way I do on these podcasts with the basics, the foundations, and then we'll get more into the nuance as we go. But if I was just to say, what are the component parts of a solid CDD program? Is there a way you'd break that down, Jim?
Sure. I think a solid or an effective CDD program or KYC program more broadly has, in my mind, 4 components. And one is meeting all legal and regulatory requirements, specifically Customer Information Program or CIP. 2, gathering adequate information to make risk-based decisions. 3, to use those risk-based knowledge to conduct periodic ongoing monitoring. And 4, and this isn't necessarily tied to the AML side, but to be effective, I think you need to execute in a manner that is most frictionless for customers.
Jill, would you agree with that? Would you add anything to that on top?
No, I think that frictionless to customers is also really critical. There's a fine balance between gathering and monitoring the right information versus always going back to the customer and asking, questions. There's a fine balance there. And so I think that's also a very critical element to it. We don't want to bog our customers down with the customer due diligence questions, but we also want to make sure we have a good handling and we have the right information we need to effectively apply a risk-based approach across all financial institutions.
And I think we'll come back to that, the start of the why, and there are different whys to due diligence, I think, but I'll go to the how first. How do these programs typically operate in banks specifically? Because there are different ways that you can go about achieving these different components, right? So, Jim, maybe if I come back to you initially, you've worked both in-house and then as an external sort of consultant, helping banks sort of put these programs in place and remediate things when needed. How have you typically seen them done?
Well, at the first level, there needs to be a list of a policy and list of requirements that are established generally by a second line compliance program, but more broadly, it could also be defined by the institution and its board. So, for instance, an institution may make a decision that they don't want a certain class of customer to be a part of their institution. Maybe someone in a ultra high risk industry, presented something as an extractive industry, cannabis related industry, adult entertainment. So those decisions are generally made at the institutional senior management board level. And then incorporating those at the second line compliance level will really develop a KYC or CDD policy that will define types of customers that are higher risk and, maybe just need specialized due diligence. They will also help build out a customer risk rating module. And now what this is, it differs greatly from institution to institution. Some may be a simple binary Excel that there's a couple of variations. Others may be a complex model that needs to go through model validation on an annual basis and is multi-factored and updating on a real-time basis. So those are key baseline components. Then you involve the first line, or sometimes it's an operations back office, who is collecting this information for the customers as they onboard. This could also be done through digital means if that's the acquisition measure. Once that baseline information is there, there's some verification of the information that the customer has provided. The customer is officially onboarded, and then they're part of your broader ecosystem. They have a risk rating, and now that risk rating is subject to generally a periodic review cycle. This has changed over the past few years as how these are done. Traditionally, you would see high every year, medium every 2 years, low every 3 years. That's gone away in some ways, that Some institutions are using an ultra high every 6 months. The high every year has stayed around, but the medium has gone down in some places to 3 years, and the low in some places gone down to 5 years, 7 years, or never. It's all trigger based or periodic review based on other factors that aren't necessarily a timeline situation. So that's where the second line will necessarily come back in and be involved in some of those reviews. And, if you have an issue where a customer needs to be offboarded, this is where the all come together. The first line, the second line, potentially management on the ongoing maintenance of a customer if they presented a significant risk to the institution.
Okay, so you kind of got the institution strategy needs to be set first of what they want to go after, what they don't. Therefore, the risk appetite is kind of derived from that. Then have your policy. Then you'll have sort of your process of how you're going to go about acquiring customers, how you embed these controls in, and then you define within your risk grading system how often you're going to periodically review, as you said, or trigger-based or perpetual, if you're just going to monitor everything all the time for other reasons.
Yeah,
Jill,
Jim made a very good point. Yeah, I wanted to put this up. One of the things I think that was missed in his is he was talking about the institution at the board of levels, the first line and the second line, really having great communication with each other and effectively updating policy or the model for the customer risk rating. And that's one of the things that I'm seeing is, sometimes a disconnect is, the business may have changed their strategy and they haven't really informed the second line. So good policy hasn't been implemented. And so I think the communication between all of those three groups is really what makes also a very effective CDD program. And I think that and you're seeing that in enforcement actions and all kinds of things, but that is a fundamental part of an effective CDD program is the communication between those three groups and on a routine, consistent basis.
And to Jill's point, what I've seen in a number of recent MRIAs is defining those as feedback loops. So having these defined steps and processes where there's communication between the different stakeholders.
The last thing you want is your first line, your sales team to go after some new group, new product type, and your second line that creates the policy, puts in these controls, has no knowledge of it until after the fact. It's too late at that point. The second line and your policy team and the board, y'all really need to be having these conversations before you actually go after this market or go after the clients. So that's also, and I've seen that a lot more post-COVID as different financial institutions have tried to find different revenue streams. But that is just critical, that feedback and communication between those three groups.
Just to give one anecdote based on what Jill's describing, I had a client last year where they were looking to increase their risk profile and take on some potential riskier business areas, which would lead to potentially higher fees for them as well. So what they did at the second line, and they brought us in to really help define what those risk areas were. And they gave a list of 6 ones they want to highlight at the onset and say, okay, why are these riskier? What is the industry speak as to why this particular area would present higher risk for money laundering risk? 2, how does that risk manifest itself in the transactions that may be present? 3, how can the institution mitigate that risk? And 4, is this something that should be within their risk profile, or is this something that would be beyond the scope? So, we assisted and advised on those 4 components. I don't know exactly how they implemented everything, but hope we gave them the baseline to execute.
This is audio only, so those that can't see, everyone's got their fingers crossed on camera. I was just going to think a lot of what we're talking about here is the people, right? The communication, this approach of do you operate in a silo or do you have good communication? Do things flow from one team to another in the responsibility area? How are those structured as such? Like, is there a sort of one approach where it is very sort of you're in charge of this piece and this piece only, and then you hand over, versus is there a sort of more of a holistic approach that you've seen banks take? And then also, does that change depending on sort of the tech they have involved? Because I think, Jim, you mentioned obviously if there's digital acquisition channels, that is different to going into a branch. And then you also both talked about that frictionless customer experience might be one of the goals of a CDD program. I'm just wondering how that comes together. If the people are all lined up what do we then do to operationalize this?
So, and Jill, I'd love to hear your opinion on this, but sadly, I see in the largest, most complex institutions where there is robust first line, robust middle office operations, and robust second line functions, where there is a pretty significant degree of siloing. And there people are handling their individual areas. There may be some feedback if there are issues that are developed, but the real communication comes in those sense at the back end when there is an exit or there's significant issue where senior management, both on the first line and second line, need to get involved, but the day-to-day execution is generally done in a silo. As you move down in smaller institutions, when there's less people involved and people wear many hats, there's greater intersection and greater interaction. It's possible that your BSA officer sits upstairs from the branch where the people are onboarding the customers and executing them, and they can just run up and say, "Hey, I have this customer. It's an interesting situation. Can we have a conversation while they're grabbing a coffee downstairs?" So, the most institutions that I work with tend to be on that larger side and tend to have some greater silos in place.
Problem is, I feel like with these silos, especially the larger institutions, there's a lot of pros and cons to it, right? So one of the pros is the expertise, right? If someone is just responsible for a portion of the customer due diligence or, a little bit, working outside of the first line, they really become an expert on that process, the legal, right, which Jem mentioned as like one of the critical elements, right, of an effective CDD program is making sure you understand your legal and regulatory obligations. They really understand that from top to bottom, right? And so that is one of the pros, unfortunately, of the silos is it really brings in specialized expertise. But then one of the cons is that you don't see the holistic risk and you don't see the holistic sometimes customer across the organization. So there's a lot of pros and cons, and I think that goes back to that communication is what is best for your institution and why, and what risks are you able to deal with, or do you have other controls in place to combat some of the risks of either siloing and or not siloing from that perspective. So there's pros and cons to both approaches. I have my own personal opinion, and sometimes I feel like the silos duplicate efforts, which sometimes makes things a little operationally clunky. But like I said, but then you have the expertise there. So that's like I said, there's pros and cons to those silos, but you really see it at the largest global institutions from my experience.
Yeah. I always, a lot of my time learning KYC was learning with sort of fintech businesses who generally weren't going to try and silo, right? They were going to try and have generalist teams, but enabled by technology so they could scale and compete and go after larger institution sort of books of business in whichever little piece of it they were looking to go get. And the interesting thing with them is that it's like it is the technology ultimately. Like if it's a rule, then a person doesn't need to know. It's almost the attitude, right? Like it's good if they know, but really we only want people to make the in-between decisions. Anything that can be boiled down to a rule, we can program it, and therefore you don't need to look at it. And so like I've always thought that's interesting because you'll see that scale really quickly and people have built huge customer bases. But you'll also see obviously like the fraction of a percentage point of people who are really upset when they've been caught out by the rule and sort of said, this wasn't fraud, this was just me trying to do a thing, and my bank, and now I can't speak to anyone because naturally there aren't as many staff. So there's no phone number. You just you speak with the chatbot and cross your fingers again. So there's like, as you said, pros and cons, Jill. But I wonder if there is a best of all worlds that could be created.
Well, and this is just my personal opinion. And this is probably, I'm a former educator, used to teach high school, right? I think understanding the why you are doing something also helps. And sometimes if it's all technology based and we don't spend the time training our first line and our second line and everyone in between the why we're doing something, it dilutes the purpose of why we're collecting, why we're verifying. And so I think you can create the rules, right, and use data and technology, but you also need to do enough training to train your staff on why we're doing it this way and why it's important.
Let's talk about that. I mean, you kind of have both touched on it already in terms of what is the why behind CDD, and Jimmy mentioned right from the start, like meet your legal obligations, because otherwise, you might not be in business too long. But is there a way that you'd sort of phrase that if you were training? Maybe take Jill's example, like the first line. How would you explain the why behind CDD to maybe someone who isn't, a lawyer by training like yourself?
The first thing is giving them the law that's in place or the regulation that's in place. So in the United States, primarily, there are 5 pillars of AML, potentially 6th with the effectiveness MPRM that's been out there. But the 5th pillar of the CDD rule came into effect as a final rule of May. Well, the final rule came in May of 2016, and then it went into effect of May of 2018. And that CDD rule has 4 components: to identify and verify the identity of customers, to identify and verify the identity of the beneficial owners of companies, to understand the nature and purpose of customer relationships to development customer risk profiles, and to conduct ongoing monitoring to identify and report suspicious transactions on a risk basis, and to maintain and update the customer information. And so that's the baseline legal situation. And to really get employees to understand what the impact is, there are many nefarious actors that are using the U.S. banking system to funnel the proceeds of drug trafficking, human trafficking, other illegal activities. And they are, in essence, sometimes doing this under false pretenses by establishing shell companies at institutions. So this is real risk that goes on. I encountered an engagement a few years ago where someone had an unlawful money service businesses account, and they were running the proceeds of drugs, prostitution, gambling through a faux account through an institution. And there was ultimately a series of federal indictments and jail times for the parties behind this. But this is real crime. This isn't something that's hypothetical. It's not just some paper moving. It's not just some exercise of futility. You are protecting both the institution and, frankly, the U.S. marketplace from illegal actors taking advantage of the banking system. So to really emphasize their role in playing a key part of this. So, and show the interplay where law enforcement comes and they pull records, they pull SAR records, they use AML information extensively in their investigations. So my goal with employees training is always to make it real for them and show how it impacts the broader world.
Jill, does that resonate? Because I know you did that role, right? And then you worked through.
Yeah, and this is, I think, a lot of people in this space, right? And a lot of us are probably a little too idealistic, right? We would be the, pageant contestants. They ask, what do you want? And we would explain world peace, right? But it's kind of the same thing. Like, we really believe what we're doing with effective CDD programs is really protecting the U.S. financial system as a whole. And that's also protecting the U.S. population as a whole, because these, Jim mentioned the human trafficking, the drug trafficking, all these frauds and scams that are affecting our elderly, right? That money has to flow through something. And they're using the U.S. financial system to profit from these illegal and awful activities. And so an effective CDD program also really protects the U.S. financial system and also the entire U.S. population. And so, like I said, it's a little bit, I want world peace, but most of us in this space really, truly believe that is what we are doing with effective CDD programs.
It's always good when sort of hear the passion when you speak about that, Jill. I can safely say that I don't think I'll ever be put into a pageant. So that might be.
I don't think I will be either, because I'm a little bit too outspoken. But if you ask a lot of people in this space, like, we really believe that the work we're doing is protecting the U.S. financial institution. And with an effective CDD program, an effective risk rating, we are really looking at the risks, mitigating the risks, and hopefully finding those illicit bad actors along the way to help law enforcement with those indictments that Jim talked about in some of those prosecutions.
So, well, I hope that's given everyone that's listening that maybe isn't directly involved in CDD, maybe just a bit of a 101 of what goes on, what we're trying to aim at here, and how it might come to be. Let's talk a little bit about some of the details and nuances. We've touched on some of this already, but the risk-based approach kind of underpins almost everything, it feels like, when we talk about this space. And Jim, you mentioned a few different areas there, right? Like somebody might say, I don't want to work with the adult entertainment industry, or I don't want to work with even the legal marijuana industry, because there's a federal state thing there. Could you maybe talk through how the risk-based approach shifts, how CDD operates? Like, what would be the differences when you are looking at a high risk versus a medium, and what are the types of things that normally go in that risk module?
And the risk-based approach is the U.S. system for anti-money laundering. For sanctions, we do have a strict liability system, but everything in the U.S. is risk-based on the anti-money laundering side, inclusive of CDD and broader KYC controls. So generally what we'll see is a different degree of information that's collected. And sometimes this will impact the number of percentage of beneficial ownership that is collected for a party. So, the standard for the CDD rule would be 25% or more in the United States. It differs in some of the European jurisdictions. Sometimes we will see in a higher risk entity where they'll go down to 10%. Sometimes I've seen in a ultra high risk entity where they wanted anyone over 5% as a one-off, so to speak. The other area we'll see is the enhanced documentation that's collected. There's a certain baseline documentation that's collected for every customer. Some institutions are under what would be deemed simplified due diligence because they're publicly traded and all their information is readily available via K1s or other filings. For most customers, you're getting some degree of information on the entity. It may be their corporation documents, articles of incorporation, where they're registered, things of that nature, what their business line is. For those that are deemed higher risk, it may be a more specific set of documents. Sometimes it's based on high risk characteristics generally. Sometimes it's based on the type of institution that is a de facto high risk based on the industry in which they operate. And the other thing you'll see is the increased monitoring. I already referenced the periodic review cycle is going to be enhanced for higher risk customers. We often sometimes see that in transaction monitoring scenarios, there's different thresholds or different rules that may be in place for high risk customers. And, I know we use the word higher or high risk, but we generally see it, those that are deemed high risk are getting this special treatment rather than medium versus low.
Joe, anything or from your experience, right, working in the banking sector, like when you looked at these different markets, was it as simple as just like, right, once it's in high risk, then that's one bucket and we do these things? Or would it differ a bit more? Like, hey, if this person's a crypto institution versus this person's a correspondent bank, maybe, how would you then go about your next action?
I think it really is industry specific, right? So, for example, if I'm onboarding a high risk or, I have a high risk customer that's maybe in like logistics, right? I may be asking more questions about their supply chain versus a customer that's in crypto. I may be asking about their AML program, their controls. So it's a little bit of why they're high risk on what a lot of your next steps are, I would say. But that is that effective policy that goes back to the CDD on what will make you comfortable banking or having a relationship with these higher risk customers. So I think understanding the why they're high risk, once again, going back to that why, and then effectively making sure that either they're mitigating the risk or you're mitigating the risk is documented and documented well. And it did do some of those enhanced documentary requirements that Jim talked about earlier in beneficial ownership requirements.
Jim, you obviously work with many institutions now as a consultant role. You obviously get exposed to more different places rather than just in one. Is there things that people typically get wrong around risk-based approach, or is there bad practices without naming any names? That's not that this isn't the show for that. I'm just wondering if people sometimes think they've got a risk-based approach when really they haven't, and if there's any pitfalls that people can avoid?
Definitely. So there's a few pitfalls that I've seen. One is the use of overly broad statements in policies. And I will cite a specific example here. I encountered one client that had a number of branches in states where marijuana was legal. And they had in their AML policy, we do not bank any clients that derive income from marijuana related sales or the like. Now, that could be true for they're not going to onboard someone like the green galley or someone who's selling weed, selling cannabis directly to customers, or someone who's a gross grow farm. However, they had a number of strip malls in their portfolio, or real estate companies that own strip malls. Many of these strip malls had significant number of cannabis stores in them. They had a number of hardware stores in their profile in areas where there are significant grow farms. So these would be deemed the 2 or tier 3 marijuana related businesses. So to have an overly broad statement that is in essence setting you up to fail, because you're either going to offboard all your real estate holdings in the given areas where there are. I live in New York City now. Every business that goes out, it seems like a marijuana cannabis shop is coming in. So, this is not, and we're not fully legal here. We're partially legal. So in some of the West Coast states, it's even more abundant. So that's certainly one of the pitfalls. The other thing I've seen in terms of operationalizing the execution of this, clients have these dynamic customer risk rating models, which both may increase the customer risk rating over time or decrease the customer risk rating over time. And I've seen direct regulatory criticism for those where the model would move an entity from higher risk to medium risk, and there is not a subsequent review of the transactions and a full periodic review by a human being that would justify that move. So, they automatically, it's been a high risk, it's had a periodic review, the system says it's medium, and then they just treat it as medium. What institutions really should do in that realm is have a human make a determination and then get it signed off by leadership that this entity is now a medium risk entity.
Okay, so really that documentation and paper trail of the judgment rather than purely computer says yes or no. That's sort of interesting
Indeed.
to hear that. And to go back to the regulation aspect, Jill, when you were last on, we were talking about the Corporate Transparency Act with another Jim, actually, not this Jim, but a different Jim. And I just wonder how you think that might impact CDD for banks, if at all. I mean, we're several months further on since that recording.
Well, so right now, most financial institutions are operating under that CDD rule that went into effect of May of 2018. And honestly, until they are told otherwise, that is what they are going to be doing. Yes, the Corporate Transparency Act has passed. There are some lawsuits and it's been put on hold, and we're also waiting on further regulatory guidance. So until then, right, most financial institutions are operating under their legal and regulatory requirement, which is the CDD rule of 2016, which went live in May of 2018. So though that's until otherwise told, I think that's what everyone's going to be operating under. Jim, unless you have any other thoughts there.
Well, just some more context, because I know not everyone on this podcast is as in depth on the Corporate Transparency Act as you or I. So, the Corporate Transparency Act passed January 1st, 2021 with a 3-year sunrise period. And there were 3 large rulemakings out of that. So September of 22 defined who needs to report and what they need to report. December of 23 defined access. And then the third element, which is still waiting for a notice of potential rulemaking, as Jill described, is going to modify and amend the customer due diligence rule of May of 2018. We are still waiting for that. So, this has been in the Federal Register as coming out at least 4 times in the last 2 years, and none of those deadlines have been met. In addition to the lawsuits that have further muddled the situation, I think realistically, we're at a point now that it's 2 years from now at the very earliest that would have an active final amendment to the CDD rule that would be in place. And so every institution that I've encountered with, I've been at conferences where this has been a survey of those in the room. My institution hosts a quarterly CDD roundtable where we have this as an ongoing topic, and no one is doing anything differently right now. They're keeping awareness of what's going on in the broader situation, in the broader legal, in the courts, but they're taking no action to change their practices because they are still governed by the May of 2018 final rule, and they will be for the foreseeable future.
Understood. And maybe it's that we do a different episode about those lawsuits and potential impacts. That would be a whole different topic. Well, what about other regulatory changes? Is there anything that's sort of happened recently or that is on the horizon that you think is going to affect CDD programs writ large?
Well, the one thing that I earlier referenced, in June of 2024, there was a notice of potential rulemaking, what's being deemed the effectiveness NPRM. And the primary components of that would be making the risk assessment a sixth pillar and ensuring that the risk assessment drives the other five pillars. So, while this may be done implicitly or tacitly, institutions would really have to take the results of the risk assessment and show how it is driving their CDD program, their internal controls, their training, and the like. So, that will be, and, there's a lot of talk about which elements of this may pass. I know there's been pushback by some of the major institutions, but if that comes into play, both incorporating the risk assessment as a required element, and 98% of institutions already have a risk assessment. They'd also have to incorporate the national priorities into that risk assessment and then use the risk assessment to drive the other aspects of the program. So, they have to be a little more intentional and explicit about several elements here.
Those operationally and potentially technologically, that might be where the change is. Even though they're doing a risk assessment, it's the actual how you're doing it that's gonna matter maybe. Jill, are you about to jump in there?
Yeah, I mean, it's, really critical. And I think a lot of it goes back to those national priorities, which, as you may know, I'm kind of passionate about the human trafficking side of it. But it's also really evaluating, do I have risks in these areas? How am I mitigating those risks, right? And it's just putting on paper, basically, what most financial institutions are actually doing. That's my personal opinion. I'm sure Jim has other thoughts, but like I said, 98% of financial institutions already have a very robust risk assessment framework. It's just codifying it, and going back to what Jim said, an effective CDD program is your legal and regulatory requirements, and just making this an actual requirement versus a nice to have, which most do have. I do want to go back to that question. You're saying what do you think has changed? And Jim mentioned this rule. I also want to mention, we talked about the talk between the board of directors, the first line and the second line. We have also seen that play a more critical part in enforcement actions lately, about making sure the board of directors is fully aware of what's going on with your AML and CDD programs. So I've seen that this year as well.
Yeah, so it's sort of that communications piece and the reporting and the dashboarding and all those beds. I was going to ask around, Jim, you mentioned it earlier around CDD. Has this risk-based approach, or AML as a whole has this risk-based approach. Sanctions has more this liability approach, and sanctions is one example. But how would you describe, if there's going to be some changes to CDD potentially, or if there were changes for any reason, how does that have a sort of knock-on effect to other areas of regulatory compliance? Is there anything you've sort of seen that might help an audience member think, hey, if something comes in or if we have to change something, what other departments that are also linked to this overall risk mitigation pieces of the banks, what would they need to think about?
Sure. You referenced the sanction side. So, all institutions, and even beyond financial institutions, corporate parties as well, are generally doing some degree of screening their customers or their vendors or their suppliers. And the information that's screened is only as good as they collect. So what are they collecting and verifying from their customers as a result of their CDD program? What are they collecting? Are their beneficial owners? The OFAC regulations have a 51% ownership threshold for, SDN determinations and the like. So, if institutions at the CDD level are not collecting this information properly and verifying this information properly, you're just setting yourself up to fail down the road. It's not feeding the sanction screening tools. you're potentially missing, true hits from an SDN or other sanctions perspective. The other area would be anti-bribery and corruption. Are you identifying part of, as part of CDD practices, you're going to identify those with government ties, or in the AML space, PEPs, politically exposed persons. This is essential for any ABAC program, that where you have those relationships either on the supplier side or the customer side with those who have positions of government authority that would be subject to potential abuse. So, it's all very an intertwined system. But these are two of the areas that would be key outputs from the CDD information.
And it's interesting going back to, as I mentioned, some of my experience building this with technology firms. All of these things would be in one flow. All of these things would be in one tool. So it's interesting, again, when you start to think about where there's silos, it can create maybe the blindness, maybe to people maybe they don't think about the knock-on effects, or hopefully they do, but maybe all of this work happens in a different room or on a different screen somewhere, whereas the smaller firms might be doing all of this at once, which gives them control, but maybe overworked at a certain point.
We just had a conversation with a client this past week where they have one of the leading sanction screening tools, but they don't have the module for adverse media checked. So this is something that would be part of their license, but they're just not utilizing that information. So, to be aware of the capabilities of the tools you have, what information you're getting. Are you getting PEP information? Are you getting adverse media? How often is that information being run? Are key considerations that institutions need to undertake as they know their technology.
Jill, when you've sort of, obviously, as I've mentioned, you've obviously worked in banking, and now you've been working for Moody's, working with a number of clients across a number of sectors, including banks, of course. Are there any sort of like pet peeves you have? Anything where you're just like, come on, guys, we're better than this? Any trends that maybe like you really want to see corrected on the CDD front?
Yes, it's a small little thing. It is, we mentioned feedback loops. I think we need better feedback loops from other operational teams within the financial institution. For example, our credit teams will typically know first when there's a change in leadership or a change in ownership, and making sure that feedback loop goes back to the CDD AML team so they can do the effective screening and they can effectively monitor their risk. A lot of times we don't see that connection and that full feedback loop. So we're not looking at the holistic risk of all the different types of risk, credit risk, financial risk, crime risk, right, of a organization or a person that's one of our customers at a financial institution. So that's one of, I think, my pie in the sky goals, is to correct those feedback loops. But I think it would make everybody's lives a lot easier. And then we would also have consistent information across the organization of our financial institutions. So that's just one small thing for me.
Yeah, I'm just thinking it probably goes back, or maybe you guys correct me if you disagree, but it feels to me like that will go back to sort of this idea of master data management. And if you've got these, centralized golden records, so to speak, and the different departments are drawing on them, they also need the ability to correct them when they get new information, or to submit new information to those to be verified. It might be that the credit team heard about a leadership change, but it isn't actually official yet. It's not, the ink is not yet dry, but they've heard the rumor mill. So they might want to submit it, but somebody needs to check it. But if you get that master data management, or MDM, correct, it will make everything else easier. And then CDD is the front door to MDM, right? Like, that's where you're going to get most information at the start. It then lives somewhere, but then it could be corrected, sort of near real time by everyone else. Jim, any pet peeves or any further comment?
Well, my pet peeve kind of dovetails with Jill's a little bit. And mine is, and I've seen this at multiple institutions where I'm reading a periodic review, or I'm reading a case investigation, and they'll have information in there that seems inaccurate based on what else we can see in the customer profile. So, for instance, I see that this person is listed as a job that is not aligned with the salary that's coming in for their transactions. And I will say, it looks like, I'll use myself, for example. You have Jim Daly as a law student. I found this LinkedIn profile for someone who graduated law school, but is now at PwC. I look at the transactions. He's getting paid by PwC every 2 weeks. We can tie the oh, it looks like there was a promotion here. There's a change in the salary at that time period. And then the response is, well, LinkedIn is not an official source of record for us. It's not in our customer records. Like, okay, well, why don't we update this? Why is there not a feedback loop to get that information in? Or if you don't want to make the statement that it's true, use the word apparent. It's apparent that he's working at PwC in this function, because everything else in your records is telling you that this is who this person is, but some outdated document that has been sitting around for 10 years and there's no active and reliable mechanism to update it is saying something else. So take what's realistic and not true in front of you and not be tied to some, official document, so to speak.
Yeah, it feels like, if it looks like a duck, sounds like a duck, quacks like a duck, but you don't have a DNA test, you might still say it's a duck.
Exactly.
You need that DNA test to confirm the
exactly, just to be sure. Just to be sure. And we've referenced these a couple of times just briefly, but enforcement actions, obviously, a big part of what sort of drives this industry forward. I always wish it wasn't. I always wish people were striving to be ahead of that game, and I think there are pockets of that. But have there been any enforcement actions that you would sort of point practitioners to like learn from that maybe have come up in the recent history around CDD and what we should all be doing?
I can cite a few things here, and then Jill, feel free
please.
to add. The bulk of public enforcement actions that we've seen over the last 2 years have been to those that are deemed banking as a service or sponsor bank or otherwise providers for fintechs. I think the number is about 16 of these public enforcement actions now. These tend to be institutions on the smaller side, community bank size generally. But we're seeing they don't know their customer's customer. So you're onboarding this fintech and you don't have a full understanding of what they do, what their protocols are for their customers to truly understand what's flowing through your systems. And, pretty much in every one of these, bring back to an earlier point that Jill brought up is, board of director oversight, board of director knowledge of this. Are you getting the right KPIs, KRIs on these particular relationships and bringing them to your senior management and board and ensuring that they understand the true nature of this risk that's going through? And beyond those series of ones, there have been ones to 2 of the 20 biggest institutions in the country that have been public orders, a written agreement with Wells Fargo and a consent order with TD Bank that are very lengthy. So there's a lot of detail in those that I know institutions have been breaking down and assessing how do these apply to our institution, and taking those as lessons learned. And that's certainly something that we encourage at all levels. We encourage, as part of the board training or board updates, the board understands what's being done in the marketplace with some of these consent orders. And for the second line to take it, or second line and first line to take it and see the deficiencies that are outlined, how they may impact their own institutions and how they can get ahead of a regulatory exam on some of those issues.
Jill, I know you and the IPL team here at Moody's, you look a lot at both the regulations and the enforcement actions to see how we can, one, help customers, but also think through, the next wave of product work as well. What have you sort of been picking up from the themes? Anything in addition to Jim's observation?
One of the things, and I think I've actually mentioned this on a podcast before, is that you can't grow your sales staff without growing your KYC AML staff, right? That's why in some of these enforcement actions, you're seeing backlogs, you're seeing flaws really develop in the program because the CDD teams, the AML teams, they're not staffed properly as an institution is growing and sometimes growing quickly. The board of directors should always ask, hey, if we're going to add 10 salespeople to focus on commercial real estate, how many, AML officers do I need to help support that? And that should be part of the decision making every single time. And so I think that has been some of the disconnect as, you're going after new revenue streams. You're just not staffing at the same growth, the KYC and AML operations teams, or finding efficiencies with data and tech to compensate for it.
Yeah, I was going to say that's the interesting juxtaposition, right? Because we're also hearing that this overall, we need to reduce the cost of compliance and the burden of things. And often we're sort of over here with the rest of the vendors. We're going, well, yeah, invest in the tech, you'll get more automation, and then it's not necessarily about reducing headcount. It's about that redeployment. If someone isn't doing the busy work, they can do the hard stuff, right? They can do the judgment-based stuff. They can support the next piece of growth.
But you can't do one without the other. You can't increase sales or new revenue streams and push that without also giving the right resources, whether it's people, data, or tech, to these KYC, CDD operations teams.
This is generally when we get called in and when the regulators find issues because, the business has outpaced the compliance and, they're playing catch-ups. They need to bring in external assistance to play that catch-up in essence.
Yeah. There's definitely something there around prevention is better than cure. If you need a cure, then call Jim. And if you want to stay ahead, then call Jill. I'll give you some tips. No, look, I've got an eye on the time, but I do want to ask, I got a couple of really good audience questions and I want to make sure I ask them. One was very linked to what we're just talking about now, right? So was if you what would you be investing in today if you were running CDD for a multinational bank? And Jill, maybe I'll throw it to you because you just sort of talked people, data, tech. If you can pick one, where are you going?
Ooh, it's not an easy answer because I need to know what they already have and what their risk-based approach is in the policy. So I can't say like one thing for sure. But I would maybe invest. The first thing I would do is I would probably actually review my master data management strategy is what I would do. And if I needed to invest, that's where I would invest probably first, because that's going to funnel every operational team, including the CDD team. So I guess that's my answer. Probably not the right answer, but that's what I would do.
No, it's a hot take piece. So, and the follow-up to this, and I'll stay with you, Jill, because it is a kind of a two-parter, is that was for a multinational bank. What about if it was a national bank or regional or a community bank? Does your answer change, or do you think it stays the same across the industry?
I think it definitely changes, right? I think you need to know your risks for your customer base and your geography. And that's going to look different for a national, multinational, regional, and or community bank. What drug trafficking looks like here in Texas is going to look very differently to what drug trafficking may look like in Kansas, or human trafficking or organized crime. And so you really need to understand your market and what that looks like so you can actually effectively manage those risks. And so if you haven't, especially if you're a community bank, I would making sure I'm having really great conversations with my local law enforcement to understand what those type of crimes and how they're seeing it are in my local community, and then putting that into my risk assessment and making sure I'm mitigating those risks because I want to protect my community, and that's the way I do it.
And Jim, if I come to you with the other question we got, I would love to do both, but again, as I said, just on the time, I thought this was quite an interesting one. It was, do you think CDD will become more embedded in other functions? And obviously, Jill used the example of a credit team earlier, who may know something that would be relevant for CDD, and how do they get that there? But there's this idea of embedded finance. Do you think there'll be embedded CDD in different parts of banks in the future, or maybe even in the present?
I do. I think we're seeing more that there is some sort of 1.5 line or individuals that straddle between different functions and have the AML knowledge, especially in some of the larger institutions that may be business line compliance officers that are bringing in these components therein. And, really understanding that an institution needs to look at this in a holistic manner and ensure that there is not necessarily a single solution, but a unified approach, that the customer due diligence information is being captured at all the right places and it's being funneled to some place centrally that can be useful. We're also seeing, non-banks, corporate institutions taking on some of these CDD concepts to understand their customers, understand their suppliers, understand their vendors. So I do see this continuing to grow. How we see the intersection with the Corporate Transparency Act and the Beneficial Ownership Database, all that is very much up in the air, how much people will use that. But I think the conceptual notion of CDD being pervasive throughout an institution both in banking and frankly non-banking, is going to continue.
Right. Well, really interesting stuff. And I always finish by asking where else can listeners go if they want to learn more, whether that be you guys' own content or just things you've seen. So, is there any blogs, webinars, podcasts, books, or otherwise that you'd point people to that want to dive in a bit deeper to this?
There's a lot of opportunities for information out there. ACAMS is the most established entity out there. They publish alerts. They publish ACAMS today. They have various conferences throughout the year. There have been some startup organizations, I believe the Coalition to Fight Financial Crime. I just went to one of their networking events last week. I know they have a series of education events that are planned for the coming year. LinkedIn is a great source. If you follow the right people on LinkedIn, Brett Wolf, Jim Richards, these people post a lot. You can play with look who's commenting on their pages. Dan Stepano from the legal side. If you start looking at who's commenting, things they're linking to, you'll be able to build out your LinkedIn network and see who you're following and get more information. On a personal plug for financial institutions, PwC does run a quarterly CDD roundtable. We have, upwards of 200 people that are invited. It is being done generally on a virtual basis. And, this is completely crowdsourced. People bring their own questions and we have an open discussion and dialogue.
Awesome. Jill, anything that you'd like to point to as well?
Well, one, I follow Jim Daly. That's where I get most of my information. He had a really great webinar earlier this year that I thought was fantastic. I would also, I get a lot of my information via LinkedIn, and we have some older blogs around the Corporate Transparency Act and effective onboarding, which is a lot of where you start with in your CDD process. So we'll put links to that. But Jim's a great resource, and I've been very fortunate to speak with him on several times. And then also, he is my phone a friend. Straight up, he is my phone a friend. When I have a question, I don't know who he go to. So, he's my great resource. So that's why I thought he would be perfect.
My favorite phone a friend I ever saw, occasionally it does the rounds online, is the guy who had the $1 million question, and then he phoned his dad just to tell him he was about to win. He was like, "Don't worry, I got this." And then got the answer right. So
I believe the question was around Laugh-In, and Richard Nixon was involved in the answer as well. So I was a big Who Wants to Be a Billionaire watcher back in the day. So.
Yeah,
there you go. Well, guys, on that bombshell, I'll leave you guys to it. Thank you so much for your time and your expertise. I really appreciate you being so generous with it.
Thank you for having us.
Thank you.